Hello friends, thank you for switching on once again. Today's session we want to continue with what we have been doing. Friends, we want to continue with financial reporting. We want to continue with doing financial reporting. Friends, last time in our previous sessions we have been introduced in consolidation for some lessons, some previous lessons, a good number of them. We introduced and we have been talking about lesson 1, lesson 2, lesson 3, lesson 4. We have been talking about adjustments, all the adjustment in respect to the group statement of financial position. Now today we want to look at an example. We want to look at a typical example from the past paper for the purpose of understanding the concept of preparing or consolidating a subsidiary and preparing a group statement of financial position. Remember, we have been talking about preparation of a group statement of financial position. That's what we have been looking at. In respect to holding company and subsidiary. That's what we have been looking at. And those are the adjustments we have been discussing from the previous lessons. Now there's a question here. That's December. We have December. There's a question in December 2009. Question 1. There was a question 1 examined in December 2009. Question 1. We can start with question 1A. Distinguish between the full method and the partial method of determining goodwill arising on acquisition of a subsidiary company. Now you need to remember, when we say we have two methods, according to IFRS 3, we have two methods of accounting for goodwill. We have the fair value method and we have the partial method. You need to remember these, friends. When you talk of the fair value or the full method or the market value method, computation of goodwill will involve goodwill attributable to the holding company on acquisition of a subsidiary and goodwill attributable to NCI on acquisition of a subsidiary. I repeat this, friends. When you talk of the full method or the fair value method or the market value method, computation of goodwill will not only involve goodwill attributable to the holding company, but will also involve goodwill attributable to NCI shareholders on acquisition of a subsidiary. On the other hand, when you talk of the partial method, under partial method, we only compute or determine goodwill attributable to the attributable to the holding company only. I repeat this. When we talk of the partial method, we are only going to compute goodwill on acquisition of a subsidiary attributable to the holding company only. That's a big difference with the full or fair value method. In the full or fair value method, we determine goodwill not only goodwill attributable to the holding company on acquisition of a subsidiary, but also goodwill attributable to NCI on acquisition of a subsidiary. While when you talk of the partial method, we are going to determine goodwill attributable to the holding company on acquisition of a subsidiary only. That's important. Now, friends, we look at the next item. Roman 2, Auma Limited acquired 80% of the owner shares of Sakwa Limited on 31st October 2009 for 117 million. At this date, the net assets of Sakwa Limited were 127.5 million. The fair value of the non-controlling interest on the acquisition date was 28.5 million. Required, calculate the value of goodwill using the two methods in A Roman 1 above. In Roman 2, they are simply requesting us to determine goodwill using the fair value method. Partial method is where we compute or determine goodwill attributable to the holding company on acquisition of a subsidiary only. While the full method, we not only determine goodwill attributable to the holding company, but also goodwill attributable to NCI on acquisition of a subsidiary. So let's start with the partial method. We have been given the Auma Limited acquired 80%, meaning Auma is the holding company. has acquired 80% ownership capital of SACCO Limited. SACCO is the subsidiary, and they are paid 170 million. 170 million is a purchase consideration. At this date, the net assets of SACCO Limited were 127.5 million. So, friends, this 127.5 million is the net assets of SACCO Limited at the date of acquisition. We have also been told the fair value of the NCI net assets at the date of acquisition is 28.5 million. So we are required to determine goodwill. Now, that is A, Roman 2. Roman 2, we want to determine goodwill. Roman 1, that is using Paschal Method. If we are using Paschal Method, friends, then it means that we are going to determine goodwill attributable to the holding company only. We come and say the cost of investment. Cost of investment is the purchase consideration. Cost of investment is the purchase consideration. That's our purchase consideration. So our purchase consideration here, friends, we have been given is 117 million. Then we less the group share of net assets, acquired, and this will be 80%. You multiply by 127.5 million. So I'll take my calculator, then get our goodwill. Then we are able to determine goodwill. Or I could open a cost of control account. Then I have the cost of investment. That is 117 million. Then I bring in the net assets acquired, which will be the 80% of the 127.5 million. So what will that be? Then I determine the goodwill as a balancing figure. We can also have negative goodwill, don't forget that. So that's what we could do. I get my calculator. So we come and say one of the items, let me reset this calculator. Then we say 80% of 127.5, we have the 102. There is 102. Fine. So minus the 117, we have 15 million. The same thing with this will be 102, and this definitely 17 million as a balancing figure. So that is what we have. Sorry, not 17, but 15 million. That is our goodwill attributable to the holding company. We are using the Paschal method. But two, using full method. We should remember that goodwill attributable to holding company is 15 million. We add goodwill attributable to NCI shareholders, which will be, you take the fair value of NCI net assets on acquisition date, which is the 28.5. Then we less NCI net assets in SACCO, which we found out will be 20% of 127.5. What will that be? Come to say 20% of 127.5. Friends, we have 25.5 million. If you subtract this, then you will get 3 million. So the total will be, is it 3 million? 28.5 minus 25.5. Yeah, 3 million. So that we get 18 million. Or you could easily come and say purchase consideration. The purchase consideration is 117 million. Then you add the fair value. The fair value of NCI of NCI assets on acquisition, which is 28.5. Then you subtract the net assets in SACWA. Net assets in SACWA, which comes to 127.5 million. That's what you do. If you do that, as we said, you take 117 plus the 28.5 minus 127.5, you will get the 18. That will be our goodwill. So that is another way of calculating the goodwill on acquisition if you are using the full method. Fine. Now, apart from that, we go to Part B. Part B says, Agano Limited acquired 72% of the owner shares of Dando Limited on 1st July 2009 for 250 million. On that 1st August 2009, the statement of financial position of the two companies were as follows. We have Agano and Dando Limited, as you can see. We have the property, plant, equipment. We have the investment in Dando. We have the current assets, we have inventory, we have trade receivables, we have cash and cash equivalent, we have the ordinary share capital, we have the share premium, we have the retained earnings brought forward, we have the profit for the year. We have non-current liabilities, 3% debenture, we have the current liabilities, trade payables, and we have the total equity liabilities. Addition information 1. On 31st July 2009, Dando Limited sold an item of property, plant and equipment to Agano Limited. Realizing a profit on sale of 20 million, Agano Limited was depreciating this item over its remaining useful life of 4 years. It is the group's policy to charge a full year's depreciation in the year of purchase and none in the year of disposal. 2. On 29th August 2009, Agano Limited sold goods to Dando Limited for 26 million shillings. Agano Limited sells goods at a markup of 30%. Dando Limited has sold a quarter of these goods by 31st August 2009. 3. As of 31st August 2009, the trade receivables of Agano Limited included 12 million due from Dando Limited, while the trade payables of Dando Limited included 7 million due to Agano Limited. 4. Goodwill was impaired by 25% as of 31st August 2009. 5. Agano Limited and Dando Limited had declared dividends of 15 million and 10 million respectively before 31st August 2009, but had not adjusted for them. 6. Goodwill attributable to the non-controlling interest was valued at 9.4 million. Required consolidated statement of financial position or Agano Group as of 31st August 2009, and that is some 20 or 16 marks there that you were given. So addition information is the most important. But before we even go to that, according from the required point of view, we are preparing our financial statements as of 31st August 2009, meaning our financial year ends 31st August 2009. That also means that our financial year must have started. The beginning of financial year must have been 1st September. It must have been 1st July and ends on that 1st August the following year. So it must have started 1st July and it ends on that 1st August 2009. The following year, that is. So let's go back and look at this question once again. From the paragraph, the first paragraph, we've been told Agano Limited acquired 72% owner shares of Dando Limited. This is a position. We are talking about B, and we have the structure. Some of the analysis. 1, the structure. We have been told the structure is that this is Agano from the beginning. Agano Limited has shares in Dando Limited. Dando Limited. This Dando Limited, we own 72% ordinary shares. 72% ordinary shares. And it was acquired on 72% ordinary shares. It was acquired on 1st July. On 1st July 2009. That's important. we have been told that is on acquisition date is of 1st July 2009, and we were told that we are to prepare the financial statements as of 31st August 2009. So how many months are post-acquisition period? It means this company was acquired in between the current year, and the post-acquisition period is less than 12 months. If it's less than 12 months, it is exactly 2 months. That is July and August. We can come and say that the post-acquisition, our post-acquisition period is 2 months. 2 months. Meaning it's July and August. Post-acquisition period in that year is just 2 months, while pre-acquisition period in that year is 10 months. Friends, you need to remember, if the post-acquisition period is less than 12 months, then there are two things we need to do. We need to determine the pre-acquisition retained earnings because be provided. You also need to determine the pre-acquisition dividend. So we have the pre-acquisition retained earnings that we need to determine. We also need to determine the pre-acquisition dividend if there was a dividend that were paid by the subsidiary. That's important. We have also been told the purchase consideration is 250